Warren Buffett is probably the best investor this generation has ever seen. Investing since the age of just 11 years, the Oracle of Omaha now has a net worth of close to $100 billion. And while Buffett's net worth has increased significantly over the years, so has his experience. At his ripe age, Buffett has made public some of his principles, things that he has learned throughout his life from his personal experiences. These points relate to finances and investing and can prove to be very helpful for someone who wants to be successful as a businessman. So what does Buffett have to say? Let's take a look. 1. Integrity. Buffett recommends that authorities prioritize integrity above all other characteristics when it comes to evaluating potential employees through the interview process. And this is for a good reason. When it comes to hiring, it's a sure bet that certain job seekers will demonstrate a lack of integrity while they are being interviewed for the position. In other words, you should be prepared to meet candidates who exaggerate their qualifications, make up stories, and outright lie about their experiences. This is an especially perilous move for businesses to make when they are in a frenzy of fill open positions. As a result, individuals could fail to recognize unethical actions. Buffett explains this rule in these words.
We look for three things when we hire people. We look for intelligence, we look for initiative or energy, and we look for integrity. And if they don't have the latter, the first two will kill you.
2. Read facts, not emotions. The second rule is as simple as it sounds. We are all emotional beings, and many financial decisions, rather than being based solely on facts, are made according to feelings. But when investing, we should not let our emotions get in the way of our motives. Warren Buffett says it's an easy game if you can control your emotions. 3. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett is known as a value investor who favors the practice of purchasing high-quality stocks at meager costs. His true objective is to increase Berkshire Hathaway's operational power by purchasing stocks that will continue to produce stable profitability and significant capital appreciation for many years into the future. During the panic that gripped the financial markets in 2007 and 2008, Warren Buffett was busy accumulating excellent long-term assets by investing billions of dollars in companies with well-known brands such as General Electric and Goldman Sachs. To be successful in picking stocks, investors must first establish criteria for locating companies that are doing well and then maintain their discipline. You may, for instance, look for businesses that provide a product or service that will last for a long time, in addition to having stable operational earnings and the potential for future profits. You may choose to set a maximum price-to-earnings ratio or debt level, as well as a minimum market capitalization that you are ready to accept. The goal is to locate the ideal business at the optimal cost, allowing for a profit buffer to protect against market unpredictability. Keep in mind that the value of the stock you buy does not necessarily correspond to the price you pay for it. Successful investors are aware of the distinction. 4. Only buy what you can comprehend. Buffett is a firm believer in the theory that you should only buy what you understand. According to him, this is the best way of making money, and that too, risk-free. If we spend money on things we do not know the dynamics of, we will likely have to face a loss sooner or later. 5. When you see an opportunity, take it immediately. This is a great rule to live by. Often in life, opportunity knocks at our door. However, we are so busy with other things that we ignore the chance completely. Once we do this, there is nothing left but to repent. Buffett has also lost some opportunities along the way that have cost him billions of dollars. That is why now he has made this convention his rule of thumb. 6. Our favorite holding period is forever. How long should you plan to keep a stock before selling it? According to Warren Buffett, you shouldn't hold a stock for even 10 minutes if you don't feel comfortable owning it for 10 years. Even during the period he referred to as the economic Pearl Harbor, Buffett remained faithful to his investment strategy and kept most of his portfolio intact. Unless a firm has suffered a sea shift in prospects, such as severe labor troubles or product obsolescence, a long holding period will limit an investor from being too human. This is because a long holding period requires the investor to act less emotionally. When investors are either scared or overgreedy, it might drive them to sell stocks when they are at their lowest point or acquire stocks when they are at their highest point, destroying the appreciation of their portfolio over the long term. 7. Buy at lower prices. And last but not least, Buffett likes to buy things at prices lower than their actual values. This is what most successful investors do. When buying stocks in particular, you should always look out for what the company can promise in return. If the price-to-return ratio is not satisfactory, you should not buy that stock. This was all about the 7 principles of Buffett. If you liked the video, please consider subscribing and sharing so we can keep bringing more content like this. Also, let us know your thoughts in the comments below. See you next time!